once you see gold get to 1900, the entire resource space, whether it be silver, copper, zinc, is going to start to explode.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today I'm quite excited to have a return guest on the show. I would say one of our most popular guests, not as well known, but the feedback has been quite strong for you, Rob Kientz of goldsilverpros.com. For understandable reasons, you've been doing some great work out there, research. Now you're kicking up the YouTube channel. I know you have a conference coming up about a month and a half, so appreciate you joining me here today. And how is everything going with you, my friend?
It's going well. I cannot complain. Things are going very well. We're nearing all-time highs in the gold price, and I'm just waiting for silver to pop. So from my perspective, it's all good.
Yeah, well, it's certainly an interesting time. You know, we haven't heard from him in the last week or two, but certainly I don't know what else people are supposed to think when the Fed is doing unlimited QE. And what I've been wondering, and what we'll dig into today, is that, now I think gold almost got very close to 1800 the other day. And now it's like, once you start hitting 1800, then 1900 isn't that far off with that. Heard some mark the all-time high to 1920. And as more attention grows, and I mean, because that's going to be a piece of history that the Fed, again, is guaranteeing is going to happen. And we have silver sitting here at, I guess it got beat up again today. Or no, it did get beat up, rallied again, as I'll show the chart. My question, long-winded as it may be, what's going to happen to silver as gold is crossing the $1,800, $1,900, $2,000 levels?
Well, I think the excuses for silver not doing well are slowly being eroded. Silver has lagged the gold price. Since the fourth quarter of 2018, we've gone from $1,190 in the gold price now up to $1,770. That's a $600 change. And silver, of course, has jumped from about $14 to about, $1,780, $1,790. Silver has lagged, and silver always lags the market, but I think we're running out of excuses in the silver market. I think at this point, silver should be much more highly valued than it is. It's an industrial metal, cost about $16.50 to $17 to get it out of the ground for the primary miners. There is absolutely no reason for it to be at the price it's currently at, $17.79. We should be looking at $30 or $40 silver at least, if not higher. A lot of that has to do with the futures market. It has to do with a lot of the futures market shorting that's going on, people betting on the price of silver. It's not really indicative of the market demand for silver. So people who are looking for a value investment, something they can get into which is undervalued, I think silver is probably the best bet that you've got going now, more than any sort of index fund that you can buy in the stock market, more than any bond fund that you can buy, even better than gold. I think silver is your value investment right now. I think as gold gets to this $1,900 mark, it's going to be impossible to ignore silver. People are going to start looking at that market. And it would not surprise me if when gold starts passing 1900, due to all this money printing, that you see silver start to burst up past $20, $30 range.
Yeah, that certainly makes a lot of sense to me. And, again, you quite wisely mentioned that it's perhaps more on the long-term side. And if someone said they needed income the next quarter or year, I would not send them to silver. But if you have the patience and I don't know what else you would call what's required to wait. I've been waiting 9 years. Although what I find interesting is really how the volatility has picked up recently. We've seen, there's going to be volatility to any chart, but let's start here with the blue line, where here's silver, trending up that day. And I love how you see wild volatility and then just like floats right there. Coincidentally, right by the handles where there's a lot of stops and trading activity placed. Chilton talked about that. And then as it comes here, then I think a lot of people remember, I believe it was Tuesday morning, You wake up, silver was just 45 cents lower, then actually rebounds, then gets pummeled again, rebounds a little bit, and then following into today, here it is right around 1760, then gets hit pretty good. I mean, these aren't a nickel or a dime, and not that there's any set range that it has to be, but just looking at what's happened, then just pops right back up.
Mm-hmm.
And Rob, perhaps one of the reasons why I've been fascinated by that is when you look at the chart of the gold market, this is March 23rd and 24th, where HSBC lost 200 million in a day, CIBC lost 60 million. That's what's been reported. And you see some similarities where, and keep in mind, March 23rd, that's also the day the Fed went to, because the first quantitative easing plan, obviously not enough. So they had to go to unlimited QE. And I think it's safe to say you had the demand. I mean, we've heard various reports about the EFP market really slowing down since then. And I think there's some level you would call that a market break. So any thoughts on, do you see any similarities here, or what's your, any comment on what you see there in silver?
I'll be honest with you. I think the Western markets are a complete farce, because what you see going on is a lot of futures trading, exchange for cash on contracts, or rolling over of contracts on the COMEX. It's not indicative of the physical market. And what I don't think people understand when you're talking about the COMEX or these exchanges is they're run essentially by the bullion banks. The bullion banks have the information. So as they see the trades come in, they can trade against the market, and they make money trading against the market. So the futures market is not indicative of the physical demand for the commodity itself, whether it be sugar, whether it be wheat, whether it be the precious metals, gold or silver. It's a measure of the bets against the market. It's the bullion banks betting against the positions in the market. And it's become a point at which the bullion banks are taking those trades, betting against the market, and making money off of that. And that's all it is. So the spot price you see in the metals is not indicative of where the metals should be in terms of physical trading. And I want to use an example. Years ago, I worked as a currency broker for FXCM, which was one of the largest currency brokers in the United States. And FXCM's whole marketing pitch was that they did not trade against their book. They would have traders come in that would place trades, place their stops on their trades on FXCM's platform, and they were not trading against that platform. They got busted years later for lying to the public and that they were trading against the platform. So as traders came in and said, I'm going to bid up the USD pair compared to the pound, and I'm going to set my stops here. Those market brokers, those facilitators know where those stops are. So as they look at that data, they're going to trade against that and make money against that. FXCM got busted for that and actually got put out of business for trading against their own customers in that market. And that's what happens on the COMEX. As you put in your contracts on the COMEX for the precious metals or whatever commodity it is, the sugar, the wheat, oil, whatever, the banks that run those markets have access to that data, and they bet against it. So right now they're making money hand over fist betting against the silver trade. And they're going to continue to do that until they can't do that. So the only thing that is going to change that is if people on the market stand for physical delivery. If they say, you know what, we're tired of rolling these contracts, or we're tired of accepting cash settlement, we want the metal. Once people say they want the metal, those markets are going to start to break against the people that are trading against the market. And you're going to see real price realization in those markets. Right now, you do not see that in the COMEX. You don't see it in the LBMA. The closest thing to an actually physically traded market is actually on the Shanghai. That's the Chinese market, where you actually see contracts settled more for physical than you see in the other markets. You do not see this on COMEX and LBMA. So the spot prices are not indicative of the demand for silver or for gold or any of the other commodities. And once people understand that, I think then you can take the position of take a longer term view of the markets. How long can these short positions exist in the commodities? And eventually that has to break. as people start to realize we have shortages of silver, we have shortages in gold. Once we realize we have the shortages, you're going to have more people lining up saying, I want to take physical delivery of that, and standing up to the people that are trying to take advantage of the traders in that market. It happened with FXCM in the currency market. It's eventually going to happen in the precious metals markets. You just have to take the long-term view. You have to not worry about what the chart is telling you on, June 25th of 2020. You have to take the long-term view. And if you take that long-term view, you're going to be okay. And I think right now, silver is probably one of the most undervalued assets on the market. If you take the long view and you take a position of going along silver in the next few years, you're going to be fine. But just ignore what's going on in the futures markets, because it's not indicative of the real demand for silver in the market.
Yeah, I certainly agree, and think a lot about how if you can have patience in a market where most of the world doesn't have patience, then certainly seems to be a handy thing. And Rob, I'm going to pull up something that perhaps you can explain to me. I can't figure it out, but that's why I'm grateful that you're here. This is from The Great Gold Charts Are Us from Nick Laird over in Australia. And we see the Silver Depositories ETF. So there is the iShares SLV, whose custodian is JP Morgan, who's being charged with the RICO statute. But why let that stand in the way? In either case, you see, according to this data, over the last 4 weeks, 44.5 million ounces have been added into the trust. And again, I mean, that's probably pretty shocking in and of itself. 44 million ounces. This is a market that, according to Silver Institute numbers, has been in a deficit. I believe it was 5 of the last 6 years. And then you take a look at the 10-year here. So here's up where silver is hitting $50, and here's the amount of metal. So you would have thought that when silver is dropping from 50 into its current range of 15, that normally price falls is not well. Demand is rising at a 45-degree line over the entire time, before somewhat going vertical and just piling on, let's back that out, about 200 million ounces, let's call it, in last 3 months. Can you put some of these numbers in perspective, just how big that is, and or maybe if you can explain any of how that makes sense?
So silver market is a very small market. The precious metals market is very small when you compare it to like the stock market or the bond market. A lot of money goes into those markets. The precious metal markets are very small in comparison. And the main participants in that are going to be the bullion banks. They're going to be the producers. And what you're seeing in these markets is, for the first time in years, and probably about 9 or 10 years, you're seeing people go long these markets. You're seeing people go long into silver. You're seeing people go long into gold. And this is the smart money. And the smart money always gets in before the retail market. So a lot of the bullion banks, the producers, are starting to position themselves long, because they understand the physical market, where there is a deficit into what we have available physically and what the market is actually demanding. And it's a situation in where the futures markets aren't predicting what's going to actually happen in the future. The physical markets are starting to outweigh that. And so the smart money is positioning long in those markets. You can see them starting to accumulate. You can see the money going into the ETFs. The people that invest in the ETFs are these big funds, these hedge funds, these funds that want exposure to what they think is going to be the long-term price. So you're starting to see that money inflow into SLV, for example, and GLD. That's because people think they're betting on the price going up long-term, because they understand the physical market fundamentals. The retail market doesn't understand this right now. So they don't understand where the money is going into. But all you have to do is look at those charts and understand the inflows to understand where the money is going. And eventually what's going to happen is that price has got to rise, because the demand for silver in the physical market is very strong. And once you see it start to happen in the futures market, that price is going to start to rise over time. JP Morgan, which has historically held this very large short position in silver, has started to go long. So you're starting to see those participants that have held these historically short positions start to flip their positions into the long side of the market. And that what that's telling you is they're predicting that the long-term price for silver is going to go up. If you look at just the physical, the market demand, the physical price to get silver out of the ground right now is about $16.50 to $17 an ounce. That's been reported for the primary silver miners. And in addition to that, when you have all these shutdowns of all these mines, the copper mines, the zinc mines, in which the majority of silver is actually produced as a byproduct, you have less physical silver on the market. So from a physical demand perspective, there's not enough silver to satisfy demand. And so all of these smart money entities are positioning for long in the silver market. So eventually you're going to see this increased demand for silver. And that's why it's gone up from $11 a year or so ago up into the $17, $18 range. And I think there are a lot of market participants just waiting on those shortages to start to develop in physical silver for that price to really rise. And the biggest thing that really brings money into resources, whether it be silver or gold or copper or zinc or whatever it is a rising gold price. We're seeing an 8-year high in the gold price going right now. It's challenging the 2011 highs of $1,900. Once you see gold get to 1900, the entire resource space, whether it be silver, copper, zinc, is going to start to explode. You're going to see the investment money come into those miners, and you're going to see that market start to creep up. That's what always happens. Gold is your canary in the coal mine. When it hits all-time highs, money comes into the resource space, and people start bidding up the prices. You're going to see silver, you're going to see copper, you're going to see zinc, you're going to see lead, you're going to see molybdenum. All of those resources are going to start to get bids. We're really on the cusp of that. So if you're a value investor, you're in the Warren Buffett school or the Peter Lynch school, you're looking to get in ahead of the crowd. Silver and gold are really resources you want to get into because it's not going to be long before gold hits its all-time high. I would say maybe 6 months or so, given all of the negative interest rates, all of the money being pushed into the system by coronavirus. People are loading up on gold. Once gold hits 1900, silver is going to rise. You're going to see base metals rise. You're going to see all these prices rise. So right now is the time that you want to start taking your position into silver, into gold, into all these other things like copper. The whole complex of metals is going to rise when gold hits 1900. That's been the history of the resources. There's no reason to believe that that's not going to be what happens this time. I don't think we're that far from it.
Yeah, especially because we've heard how banks are short gold and silver. Mm-hmm. And I'm wondering if the fact that now silver hasn't, as you quite well pointed out, hasn't really moved a lot yet, but gold has. Mm-hmm. And if someone's short that metal, could that be connected to this recent headline, bullion banks prepare CME pullback after virus snarl? Mm-hmm. It's an exciting headline. I wonder if those two could be connected. And then on the other side of that, if the people who were shorting the metals are pulling back, I mean, again, let's not take this report as gospel, but then isn't there kind of like a cyclical effect there? It's like mm-hmm. They're getting blown out as gold's going up. Now they're going to pull back. And if somebody's not shorting, then how does that play out?
So what happens is the banks, they're very smart. They understand the cyclical nature of the market. They understand we're getting to a point where gold is rising. They're going to stop fighting that market. They're going to position themselves to make money. Specifically for HSBC and JP Morgan, which are the custodians of GLD and SLV, they understand the trends of what's going on. They're going to take long positions in these metals, and that's why they've been getting out of all the short positions. They're not completely out, but they're starting to liquidate their short positions because they realize all the money flows are going into those funds. GLD and SLV are very much a proxy for how people feel about gold and silver. All it's going to take is one bank failure, one bond default for this entire market to just explode. It's like a powder keg. There is so much going on in the underlying fundamentals of the economy that are screaming the fact that gold and silver are going to be safe havens. Bonds are no longer a safe haven. After 30 years of a bond bull market, who in the hell wants to buy a bond at low interest rates right now? What kind of yield are you going to get out of that? there's no way people are going to flock this time to U.S. bonds, which have traditionally been the safe haven. They're not going to flock to the dollar. The dollar is strong relative to other currencies, but all currencies are weak right now. And right now, people aren't going to buy U.S. dollars except if they have to extinguish U.S. debt. They're going to go to the precious metals. And I think you're starting to see the banks sort of take positions, and they always do it ahead of the rest of the market.
Yeah, and Rob, fortunately, for anyone who has questions on that or why any of that is happening, put together the North American Monetary Metals Summit, which is an online conference taking place August 6th to 7th, so about a month and a half away, where you'll be covering all this as it's unfolding. You have quite a guest list there, and perhaps before we wrap up, you could just tell folks about what you're doing.
Yeah, so I decided to hold a virtual conference because of COVID and people can't travel. A lot of the conferences people would have gone to in, say, Denver, Colorado, or San Francisco have been shut down. So we're doing an online conference. It's all virtual, state-of-the-art platform. You can do it on your iPhone. You can do it on the web. It's completely free registration. We're not charging anybody to get into it. We've got a great speaker list. This speaker list actually has grown today. We've got a couple additional speakers. We've got Kai Hoffman of Orin Inc., who has free information on the junior resource mining market. Who's
got Jerry Huang on there, a little all-star guest list, huh?
Jerry Huang, David Morgan, legendary author of the Morgan Report. We're going to be at a lot of these are going to be sessions that people can watch. We're going to add a couple of live Q&A sessions as well. If you go to my website and click on the NAMS link, you can get registered absolutely free. You can download the app. You can start asking your questions. We'll include that in these presentations. We're ramping up our sponsors. Lots of sponsors are coming to this as well. If you're interested in the precious metals market, we are going to have mining companies. We are going to have precious metals people that sell the precious metals. You can talk directly to them at the conference if you want. This is all free for attendees.
Well, Rob, I appreciate that. I'm excited to be there, and I see you have a few other. There's Alex Newman, Denver, Dave Kranzler. All right, so it should be a lot of fun. I appreciate that you're putting that together so that, I mean, I do think it's an important time for people to at least understand what's happening and decide what they want to do is best for themselves. So, Rob, thanks again for joining me. We're going to have to...